Welcome back. Well, it's time to talk stocks and, take a look at the CNBC-TV18 list of top stocks to watch. Now, we have our team standing by. Guys, good morning to all of you. Let's kick it off with the Marico. And like we were saying earlier, there's some good news coming in here for this one consumer company. Mangalam, over to you.
Well, Marico reported a largely in-line set of numbers, which is good in the current context. The rural growth for the company has been 2 times higher than urban, and they see price growth coming by as well. Domestic volume growth at 5%, higher end of the expected range of 4 to 5% as well. And if you look at the revenues as well as the margins, absolutely in line with street expectations. Also, the company had given us a second quarter update, but the net profit was a big beat. The reason why that happened was because of, one, there was a higher other income component and lower finance costs. The key positive this time around, apart from the segmental growth in particularly Saffola, was Bangladesh. Despite the turmoil, the company saw Bangladesh business grow 8%, and on that itself, they said that this will trend higher with a double-digit momentum, which will continue. That's what they said on the domestic revenue as well, will trend higher with pricing and volume growth gradually picking up. The only fly in the ointment will be the margins, where there is inflation in both copra as well as palm oil. So will the company continue to maintain these margins, or there could be a dip, is something that we'll have to track. For starters, the stock in the green.
All right, stock in the green, we'll take that. Thanks for that, Mangalam. Well, let's hop across to Upasana. She's there to tell us about Voltas and Kaynes Technologies. Morning, Upasana.
Good morning, Nigel. First up, let me start with Voltas. The company reported largely in-line set of numbers. Revenue and EBITDA margins were largely in line, but there was a slight miss on the PAT number. Now, revenue stood at 2,619 crore with an uptick of 14% on a YoY basis. This revenue growth was mainly led by strong growth from the company's UCP segment, which is 60% of the revenue mix. Now, company's EBITDA margin stood at 6.2% versus 3.1% on a YoY basis, and margins in EMPS segment recovered and turned positive, boosting the margins further. Now, PAT number stands at 133 crore with an uptick of nearly 2.7 times on a YoY basis. And mind you that the company's UCP products, that is mainly split AC and window AC, continues to hold market share at 21% as of H1 FY25. Now, next up, let me start with Kaynes. The company's reported in-line set of numbers with the street estimates. Revenue and PAT was in line, while margin was much above the street estimates. Revenue saw an uptick of 58% on a YoY basis. EBITDA margin stood at 14.4% with an uptick of almost 19 basis points on a YoY basis. And company's PAT saw a growth of 88% and stood at 60 crore. So all in all, I expect both these stocks to open in green today.
All right. Thank you very much for that, Upasana, with those results. Well, let's talk about Honeywell Auto and Hitachi Energy as well. MNC names. Vamakshi standing by with results here. Vamakshi, good morning.
Well, good morning, Prashant. Let me first start off with Hitachi Energy. A good set coming in from the company. It's a beat across the board, much better than what the analysts were expecting. Revenue saw an uptick of 25%, and this growth is largely being driven by a favorable mix as well as better execution from the company. Gross margin improved by 228 basis points, but the other expenses saw a very sharp surge. Resultantly, the EBITDA margin saw an uptick of only 53 basis points. Nevertheless, this is much better than what the street was expecting. Net profit on a low base more than doubled to 52 crores. Therefore, this is looking like a good set for Hitachi Energy. Ordering activity was too quite buoyant. Order inflow saw an uptick of almost 12%, and in fact, this is the highest ever order backlog of nearly 8,910 crores, and this in turn provides 26 months of visibility for the company. In the con call, the management said that they're maintaining the earlier guidance as far as margins are concerned. Earlier on, they had given a double-digit margin guidance, so they're holding on to that. Operational cash flow was negative in the first half of the year, and that the management attributes this to a timing issue, and they don't see any further challenges on this front. So overall, good set coming in from Hitachi, going with a green for this counter. Honeywell, on the other hand, did not post a good set of numbers. It was much below the street expectations. Revenue saw a decline of almost 10% on a YoY basis. This has come in nearly 14% below the street's expectations. Gross margins have contracted by 250 basis points. EBITDA margin have come in nearly 270 basis points lower, and the net profit is seeing a downtick of almost 6% YoY. Nomura, who has a buy rating as well as on Honeywell as well as a target price of 60,800, said that the margin disappointment was largely due to inferior mix led by sluggish export demands from non-Honeywell entities. Overall, they are expecting a margin recovery in the second half of this year.
Okay, all right, Vamakshi, we'll keep that in mind on Honeywell. Let's see how the stock reacts. We now have Yash joining in to detail how Star Health performed in the quarter gone by. Yash.
Well, Surabhi, I'm going with red when it comes to Star Health Insurance. No doubt that the top line growth was pretty strong. The gross written premium grew at 17% in the second quarter, ahead of brokerage estimates. The net earned premium grew at 16% in the quarter, that too ahead of brokerage estimates. But the operational performance for the company, that was the pain point. That was very, very weak, both on a year-on-year basis, and it was sharply below what the street was working with. Underwriting loss, that widened about 1.5 times. It was sharply higher than what the street was estimating in terms of the loss amount. Also, combined ratio, that came in 379 basis points higher at 102.99 versus 99.2. Again, sharply higher than the numbers that the street was working with. And because of this weak operational performance, I'm going with red on Star Health.
All right. Yes, thank you very much for that. So we'll keep an eye out on the stock as it opens. Container Corporation is the next one. Vinny's got details here. Vinny, good morning.
Good morning. So yes, talking about Container Corp, not an exciting set of numbers that's coming from the company in Q2. The sluggishness that one has seen in the revenue growth of the company has even continued this time around. The growth is just at 4%. Also, the volumes, which is important, both the EXIM and domestic volume, that seems to be still lower, and it's much below the guidance that given of 8 to 10%. Management, that's 18 to 20% was the volume guidance. I beg your pardon, is what they'd given. So in FY24 also they had missed the guidance. Q1 also a guidance miss, and Q2 continues to be a guidance miss. So we're expecting the stock to open up in the red because the weak performance in the EXIM volume specifically is still continuing for the company, and commentary will be key on that front, that how do they see that moving. So keep an eye on that one.
Got it. Thanks, Vinny, for that. Well, let's have a drink. Manglam's back with us to tell us about Allied Blenders. Manglam, how are those numbers?
For Allied Blenders, it is a strong operational performance. The revenue has been a little soft, just a 2% overall growth at around 868 crores. Margins have actually expanded a fair amount from 8.5% to closer to 12%, and that's because of a 45% jump in the EBITDA. Why is that? Because one, premium products are doing well. Secondly, the company's sourcing their ENA captively, and the third part is their capacity utilization itself has increased from closer to 65% to about 75% as well. The net profit saw a further boost because of the IPO funds. The company went ahead and retired some of its high-cost debt. So finance cost has come down from 43 crores to 25 crores, and there has been a near 3x jump in the net profit from 11 crores to 47 crores itself. The company has said volumes overall were flattish, but Prestige and above saw a volume growth of 8.7%. Very important to see where the volumes grow towards the end of this year as well. See green on Allied Blenders.
All right, Manglam got that. Thanks very much for it. So we'll watch out for Allied Blenders. Let's look at Torrent Pharma. Vivek is joining in. Vivek, so how are the numbers?
Well, Torrent Pharma, today is in news on the back of a large block deal that's actually anticipated from the promoter group. So the promoter entity, Torrent Investment Private Limited, is looking to sell up to 2.9% of the total equity via a block deal today. As per the term sheet, the base size of this particular block is 2.4% and another upsize option of another 0.5%. The deal size, when you're talking about the base size, it's at 2,500, and if the company chooses to go ahead and exercise the green shoe option or the upsize option, the total size of the block would be as high as 3,000 crore rupees. A lockup of 120 days on further sale of shares. Offer floor price is at almost 6% discount to yesterday's closing at 3,022 rupees a share. Remember, at the end of Q2, Torrent Investments, that is the promoter entity, held over 71% stake in the company, so that will drop down post today's block deal.
Okay, all right. Vivek, thank you very much for that. SBI Card is the next one we want to focus on. Abhishek has got details here. Abhishek, good morning.
Good morning, Prashant. So SBI Card reported the numbers yesterday in market hours, but the PPT came in at fag end of the closing time. So the yield is at all-time low of 16.4%. Net interest margin is at all-time low of 10.6%. The revolver rate, now that's declined to 23% versus 24% in the previous quarter. This is the main number to look for in terms of earnings momentum for SBI Card, and it continues to decline. Their annualized credit cost is like Maruti ad, never gets over with respect to, being on the higher side. So annualized credit cost is at 9% versus 6.7% YOY and about 8.5% quarter-on-quarter. So for 23 quarters in a row, their annualized credit cost on a quarterly basis has been north of 4.5%. HSBC has written on SBI Card they have a reduced rating. cut the target price to rupees 580 per share. They say that there is no clear view or guidance on recovery in asset quality. The timing of earnings recovery is difficult. So they have cut FY25 EPS estimate by 25% on higher credit costs. Motilal has also written on SBI Card's neutral rating. Target price has been cut to 750 from 850, and they have cut their next 2 years, earning estimate by 22% and 19% respectively. Back to you.
Okay, all right. Got that, Abhishek. Thanks very much. Well, here's a quick recap of our top stocks to watch. The ones that have positive news flow are Marico, Voltas, Kaynes Tech, Hitachi Energy, and Allied Blenders. The ones that have negative news flow are Honeywell Automation, Star Health Insurance, CONCOR, SBI Card, and Torrent Farming. Okay, let's move on. Oil marketing companies have raised dealer commissions and will undertake intrastate freight rationalization as well to benefit consumers in remote regions. Oil Minister Hardeep Singh Puri welcomed the move via a post on social media portal X, saying that the move will benefit consumers in remote regions as fuel prices will reduce in several parts of the country. The decision will be implemented later in poll-bound states and constituencies. So this is a pretty interesting and very important development coming through. Sources are also telling CNBC-TV18 that OMCs have been instructed to keep fuel price variations within states to just about 2 rupees a litre. Sapna is on the phone line with more details on this exclusive. Sapna, thanks for joining in. By the way, season's greetings to you. This is really important because it's not really a direct fuel price cut as such, but it's a smart tweak in policy, I guess, that will ultimately it'll lower the price of fuel at the pump, won't it?
Absolutely, Cindy, and a happy Diwali to all of us here. Very quickly, yes, you're right that instructions have gone out to OMCs to keep the intrastate price variation within 2 rupees a litre, be it petrol or diesel. So as of now, we're given to understand that in a lot of remote, far-flung areas within a state, the price variation is as high as up to 6 rupees a litre. It can vary between 4 to 6 rupees a litre. Suppose I'm buying from somewhere, say it's 97 rupees something a litre petrol, and somebody in a very remote area, that person may be paying somewhere around, maybe even 4 to 6 bucks higher, depending on where the person is located, right? So, to check this, basically to remove this kind of a price anomaly within the states, these kind of instructions have gone out to OMCs and they are doing the needful. So that's one. Second, we are also given to understand, however, with the prices going down sharply in these far-flung areas, there will be an element of cross-subsidization as far as the pricing of petrol and diesel is concerned. Say, for instance, people who are in densely populated areas or where the petrol pumps are very much within easy access, say, for example, Delhi or Noida or Ghaziabad for that matter, or Bombay, there the per litre petrol diesel may actually cost around 6 to 7 paisa higher. So this kind of a cross-subsidization where the sales are much higher is likely to help the OMCs make up for the price cuts, the sharp price cuts that are going to happen in the far-flung regions. So it's a two-pronged move. One, keep the variation within $2 within a state. Consequently, prices come down. However, then there's a cross-subsidization element, 6 to 7 paisa per litre, where the OMCs will be to an extent able to make up what they are giving away in other places.
Very important story, Sapna. Thank you very much to put that into context for all our viewers. Appreciate it. We'll keep coming back to you for more. We'll take a break. We're back with the management of Maruti Suzuki as we talk about their second quarter numbers and, more importantly, outlook. Stay with us.